welcome back to my channel. So today's video is all about how to understand price action and candlestick patterns for trading signals. So to start, I have a bearish entry setup example on the screen, and this illustration just provides a guide on how to read price action in a bearish market structure. So essentially you're just using a candlestick chart pattern, and this is just providing a detailed breakdown of the key concepts so you could understand exactly how to read price action. So to begin, we can take a look at the bottom left. You guys can see where it says the ranging zone, and this might act as support, and this is good for placing take profit targets. Essentially what this zone is going to be a consolidation zone, and it acts as a support area, and it's good to take the partial profits if the price hesitates around this zone. And for those who are unaware of consolidation, what that means is basically when buyers and sellers reach a mutual level of competition. So the stock is pretty much trading up and down. It's not like a significant jump up or a significant drop down. It's just kind of an up and down pattern motion. And you can see that highlighted in red at the bottom left-hand corner. And then from there, we see the break and retest zone once the stock rises up. So initially the price breaks a support level and it retests it based on this example. And this just confirms that the level has flipped from the support to resistance, which is a key point to watch for bearish continuation. So next we see the clean traffic candle. Essentially what this does is it allows you to be able to see that the stock has making that significant rise up. And this is an area where you don't necessarily need to do much of anything except analyze what you see and evaluate the charts. From there, you move up and you see that the candle reaches that resistance area. And at the top of the chart, the price encounters a resistance level, creating a barrier that is difficult to break through. This area forms the upper boundary for that price. Now from there, we see a range formed, and this is going to be a no trading zone. Essentially, after hitting the resistance area, the price begins to move sideways and it forms a consolidation range, and you can see that at the very top of the chart. Now during this phase, there is no clear direction, and it's considered a no trade zone because you're not exactly sure what the stock will do next. So this is where patience comes into play. You have to essentially just wait it out and see what the stock will do before you confirm or before you reject any strategy or particular way of viewing the charts. That way you have exact confirmation for what the stock will do. So this can take time. Now on the right side of the screen, slanting downwards, this is where you're going to see the stop loss placement. And this is where traders can place a stop loss above the previous candle's high, and this is just used to minimize risk in case the trade goes against you. From there, we see the breakout. This is the price that eventually breaks out of the range, and it moves below the support level created within the range. And this just indicates a potential new trend direction, and it's bearish in this case. Now again, because it is bearish, you want to definitely wait for confirmation, and that's where we look at the retest. So following the breakout, the price pulls back to retest the breakout area. And this retest is important because it confirms that the previous support level has now turned into resistance, and this just solidifies the bearish trend. From there, we see the entry point, and you guys can see that on the right side again when you kind of slope down. And of course, this is ideal for the entry when the price breaks below the low of the previous candle after the retest. And this signals that the bearish momentum is continuing because sellers have now stepped in to push the price down. From there, we see the take profit zone. And this is known as a clean traffic candle area because the large bearish candle is formed, and it suggests that the price has room to move downward without much resistance. This area is also considered a good zone to take profits, and you can do that at your own discretion based upon what you have as far as your capital and then of course your goals that you're setting each and every time you trade. From there, of course, I want to mention that the setup for the time frames, it can be spotted across all time frames for this strategy, but it's particularly useful for shorter time frames such as like the 2-minute up to the 30-minute for day trading. So I really hope that this makes sense, and if you need to like maybe take a screenshot or like pause the video and rewind it, I can definitely provide more detail in a future video. But again, I just want to introduce the concepts because I know a lot of people are new traders on my channel, and I think it's important to go over the specific information that you need just to kind of understand the basics. I'm not really trying to rush through it, but I don't want to like drag it out because I want to dedicate a whole video to going over this step by step. That way everybody has it broken down in further context. But to pretty much just sum it up for this particular part, you're just looking for the key areas such as that support and resistance, look for the breakout, the retest, and it's ideal for those entry and exit points. in a bearish market. Remember that this is only for the bearish entry. So if you're looking at this trying to decide if you want to make a play for calls, that won't work for this particular strategy. So just look for those places to place your stop loss. Always have a stop loss. And then of course, while targeting those zones, though with the clean traffic areas, you can look for those take profit targets on the reverse side. So for example, when you see the stock falling on the right, that's when you're going to look for those areas. And it's applicable across multiple different ways of strategizing this. So this should be a good, clear indication of what you would need for just one of the strategies that is potentially able to be used. Okay, so next up, I do want to provide information about the patterns with signals. And these are just going to be popular patterns that are easy to read, especially for beginners. So this picture provides a summary of the key candlestick patterns along with the signals for trading decisions to either buy or sell. And then of course, these patterns are used in technical analysis to help you project the price movements based on the shapes and the sequences of the candlesticks. So I'll go over each and every one of these so that it makes sense. I'm going to go ahead and start with the hammer, and this is going to be all the ones that are going to be buy signals. So these are going to be bullish patterns. So the first one is the hammer, and this is a single candlestick pattern with a small body at the top and a long lower shadow, which of course is the wick, and it indicates a potential reversal from bearish to bullish. A buy signal is essentially triggered for this when the hammer appears at the end of a downtrend. So that's how you'll know for that pattern. And then for the morning star, this is also going to be a buy signal. And this is a 3-candle pattern that signals a bullish reversal as well. The first candle is bearish, and it's followed by a small bodied candle because of that indecision within it. And then the third is a large bullish candle, and this signals the strength of that particular time frame. And then, of course, if we look at the bullish breakaway, also again going to be a buy signal. It's a 5-candle pattern indicating a bullish reversal. Now this one, it starts with a series of bearish candles, and it's followed by a gap and then a reversal with a bullish candle. So I like to look for this one essentially when it makes sense for that bullish breakaway, because it just offers a little more of a confirmation for me personally. Following that, we see the 3 inside up, also going to be a bullish reversal pattern involving 3 candles this time. Now the first is bearish, the second is a small bullish candle inside the first, and then the third confirms the reversal with a bullish close. So that lets you know it's kind of like an indecision in a way, but it also allows you to have the confirmation that you would need. Now I want to go ahead and take a look at the bearish patterns, and these are going to be all sell signals. So a shooting star is what we'll start with. So essentially it's a bearish reversal pattern with a small body at the bottom and a longer upper shadow, which is the wick at the top. And this just indicates that the bulls have been overpowered by the bearish signals, allowing the stock to drop. So in that case, a sell signal is triggered at the top of an uptrend for the shooting star pattern. Now moving on to the bearish breakaway, this is also a reversal pattern where after a series of bullish candles, a gap forms followed by a bearish candle, and this suggests that a downward reversal is soon to come. Now when it comes to the evening star, the opposite of the morning star, this is a 3-candle pattern signaling a bearish reversal as well, of course. It begins with a bullish candle to start, followed by a small body candle, again based upon that indecision between buyers and sellers, and it ends with a large bearish candle signaling a downtrend. Now when it comes to the 3 outside down, this pattern consists of 3 candles where the first is bullish, the second is bearish, and of course it's a bearish engulfing of the first candle. And the third confirms that the bearish reversal is soon to come by closing lower than the previous. So I hope that makes sense for that 3 outside down one. That one can be kind of tricky for some people sometimes. But again, it also is going to provide a sell signal. So just to kind of wrap that part of it up, I just wanted to make sure everyone is aware. The buy signals are going to be like the hammer, the morning star, and then the bullish breakaway, and the 3 inside up. This suggests that the upwards momentum for the reversal or continuation of the uptrend is going to continue. And then when we look for the bearish patterns, we see signals like the shooting star, the bearish breakaway, the evening star, and then the 3 outside down, indicating the potential downward reversal or that it's a weakening of the bullish momentum because, of course, we know that sellers have stepped in. Now, these patterns help traders identify those entry and exit points based on the price action, and that allows for them to make those decisions that are going to make the most sense. So I definitely wanted to go over all of these. Again, like I said, I'll dedicate a future video for each and every one of them. I'm just providing like the basic general information to start. That way everyone has it when I go back to making the video. You guys can reference back to this one to kind of give you a refresher on the information provided. Okay, so additionally, I do want to discuss why a stop loss is so very important, especially for new traders, because it literally can make or break your account, especially when starting off. So you see on the screen here, I have a portfolio loss, and it's in contrast to the gain required to break even. On the left side, you see the portfolio loss, and it's based on 10% incremental movements upward. You see 10%, 20, 30, and so on. On the right side, we see that this is going to be where you would need to break even in order to make up for your loss. So let me explain it by providing the example. Let's say you were to buy a stock at $50. It could be a stock or an ETF. And if the stock falls to $40, the stock would have to reach the $50 price again to regain your original investment. And this just means you would need a 25% increase from the $40, which may be a bit difficult, especially for new traders. So again, it's always important to have your stop loss set before you even enter into a trade. And that's where drawdown monitoring is so important. So if you've never heard of drawdown, this refers to the peak to the low point decline during a specific period of an investment. And this indicates that the percentage of a portfolio has fallen from its high. Now, the constant monitoring of a drawdown, it helps traders understand their risk exposure, and it allows you to adjust your strategies accordingly. So this is where backtesting comes into play. And you guys heard me talk about backtesting before. Now, I always place emphasis on this because when you backtest, you're able to determine the historical maximum drawdown of any strategy that you have. By knowing the potential losses in the past performance, it's better that traders can make an estimate for the future risks, and you can set appropriate stop loss levels based upon the information you've already gathered. So with that being said, you can see that based upon the 10, 20, and 30% of a loss you would take, again, to break even, you're going to have to significantly make sure that the next trades or any future trades are going to allow you to be able to retain that money back. Now, I always say never chase the charts. But with that being said, you have to be very strategic about high probability setups and why you're specifically choosing to enter into trades. Now, with a stop loss, of course, you're exposed to greater losses if you don't set one, and it makes it hard to recoup your investment if the price continues to decline or if it rises, depending on if you're putting a play in for calls or for puts. And this is just an example to illustrate that. Now, of course, you guys know I always set mine to about 10 to 15% on a trade. Typically, I'm not willing to risk more than 20%. I think that's a bit too high personally, but some people risk up to 30%. But with that being said, you would just need to be able to understand that you would have to get 43% of a gain in order to break even based upon losing 30% on a trade, and so on and so forth. So I hope this makes sense. I hope it's not super confusing for anyone. I'm just showing this part of it to help people manage their risks so that you can take a look and know exactly what you would need if you were to enter into a trade, hypothetically, what you stand to lose, and then what you would need to break even. Now, again, this illustration demonstrates the critical need for managing risk constantly. Every single time you enter into a trade, you want to make sure you have a way out. Now, the recovery gains are required to become more disproportionately larger, as you can see, as you take higher and higher risks. But it underscores the importance of backtesting, as mentioned, to help those past drawdowns and then also for those stop loss placements in any future trades. And with that, that'll pretty much do it for today's video. If you found the information to be helpful, feel free to leave a comment down below. I thank you so much for watching, and I'll see you in my next one.